Something you may have seen out in the interweb, in the interweb, in the net is paying points. Well, what the heck is paying points? Simply put, paying a point is you're buying your interest rate down. You're paying extra money at closing in order to get a lower interest rate at closing. So where today's rates are, and we're sitting here in May of 2024. Interest rates are somewhere in the mid to high sixes. And let's say you think you ought to pay some extra money so that you can get an interest rate at 6% or 5.75 or something like that. 1 point is 1% of your loan amount. So if you're buying a $400,000 house, 1 point is $4,000. And that is a closing cost that you will pay out of pocket at closing. Well, what does a point get you? Good question. That's why I asked it. So 1 point is going to buy your interest rate down. Let's say the interest rate you qualify without any points. Let's say it's 6.5%. 1 point is likely to get you to 6.25%, maybe 6%. It kind of depends on what the interest rate chart, what that rate chart looks like. But it might only get you, let's say, 0.3%. So it gets you from 6.5% down to 6.125. That's only going to save you maybe $150 a month. Is it worth $4,000 to save $150 a month? I don't know. It may be, it may not be. I mean, that's essentially going to take 2+ years for you to recoup that $4,000 at $150 a month. So you got to look at it and go, well, what do we think is going to happen to interest rates over the course of the next couple of years? We've talked about before about the interest rate reduction loan. Super easy, super cheap, super fast refinance to a lower interest rate with a VA loan. So if rates drop, let's say 18 months from now, and rates drop from 6.5% down to 5.5%, you're likely going to want to refinance from 6.5 to 5.5. And like I said, it's super cheap, super fast, super easy to do. So that's a pretty big jump, that 1% jump. If you were to buy that rate down today, it might cost you, on a $400,000 house, it might cost you 2 points. It might cost you 2.5 points. So that's, 2.5 points on $400,000 would be $10,000 that you would pay at closing to get your rate from 6.5 to 5.5. Does that make any sense? Probably not. It's probably better, depending on what you believe rates are going to do in the future. It may be better to just hold off. Don't spend that money at closing. Hold off and pay. Yeah, I'm paying an extra $150 a month or something for a period of time. But if 18 months from now I refinance, it would have made no sense to buy that rate down at the very beginning. So permanent rate buy downs are something you should be a little bit leery with. You really, in the current environment, you really don't probably want to pay too many points. Now, it's totally different if the seller is giving you some money and you're using seller concessions or seller paid closing costs to buy your rate down. Seller money, sure, you could use seller money to buy points, but it might actually be better to do a temporary rate buy down using seller money, and we could talk about that on another video. But seller paid closing costs would be a way that you could use their money to buy your interest rate down, and that might be a good plan. But right now, in the current rate environment, I don't suggest paying points. So keep your points to a minimum, keep your closing costs to a minimum, and let's look forward to that interest rate reduction loan here in the next, hopefully, 12 to 18 months.